Information presented on Sky News Real Estate is general in nature. Viewers should seek their own professional advice before purchasing products or services. Sky News Real Estate may receive a fee for commercial arrangements with companies featured in this programming. Sky News Real Estate. Smart Investing.
Hello and welcome to Smart Investing. I'm Chris Gray. On tonight's show, what can you do if you want to stay on interest-only repayments and the banks want you to move to principal and interest? If mortgage broking trail commissions are abolished, how will this affect home buyers and investors that are trying to get a loan? And do clients need to see a financial advisor, or is a mortgage broker good enough? Well, joining us on the show tonight is Dean Perlman from Mortgage Advice Bureau and Charles Tarby, Chairman and owner of Century 21 Australasia. Well, welcome to the show, Dean. First time joining us. Good to get a different perspective. So do you want to tell the viewers a bit about exactly what you do?
Thanks for having me on, Chris. We provide mortgage and debt-related services to our real estate partners across the country. And we recently joined with the Mortgage Advice Bureau from the UK. They're the largest mortgage broking business there. And that was done just to provide sort of vastly improved services to the clients of our real estate partners here across Australia.
So typically you're going into real estate firms and setting up mortgage broking arms kind of within their mortgage advice?
Correct. And they've got this an amazing pool of data. And so what we do is help build and improve that asset that they're sitting on.
Sounds good. Now, obviously applying for credit is an absolute nightmare in most people's minds these days. It's always good to get a different perspective. What are you guys seeing at the moment?
It's gone on the days of really easy credit where you could walk in and sign the dotted line and walk out with whatever you're applying for. So the pendulum has pretty much swung to the other extreme. So you pretty much need to be completely across, your application, once, going in and applying for a loan with the banks. It's no longer, as I say, that easy. There's a lot of thoughts and processes that go into the whole system now.
Now, Charles, there's more and more real estate agencies now almost becoming that one-stop shop that they might bring in mortgage broking or financial services. Is that a good thing in your experience?
It's something that was there a long time ago, Chris, and it's making a comeback in a different way. If you go back to mortgage origination and the processes, lending processes going back 30, 40 years ago, I hasten to say, getting a loan today is relatively easy. In comparison, it's harder now than it was a year ago, given that, but it's incredibly relatively easy today compared to going back to when I first started selling real estate, where there are allocations that were given from banks to solicitors, and then solicitors would allocate them to agents if they had a relationship with the agents. So they started developing this one-shop stop all the way back. People were selling insurance, or real estate agents were connected to travel agencies. So you go into your real estate office and it was a travel agency as well as, at the same time. They were a very, very big part of business in those days. They drifted apart. And they're coming back again because, as Dean would know, when you're selling a property to somebody, it's an emotional time, a really emotional time. And a lot of people don't have their finances organised, or if they do, they're quite open to a comparison. So at that time of making a decision, an agent can sit back in their chair and say just one word, finance, and people say, oh, look, we've got it organised. And we say, look, let me just do a quick comparison for you. Changes everything straight away. And if people want that property that the agent has, they'll often listen to what the agent says at that point in time.
Now, Dean, I'm always a fan of having a third party in a transaction, whether it's getting a job through a recruitment agency or something, because suddenly if you go and tell credit the wrong information or say I'm about to have a baby or something like this, then it can all go wrong. I guess, what are some of the tips about giving your information to credit if you are dealing direct with a bank? Is there a certain way that you need to give them that information, or certain information that maybe you wouldn't give?
You have to tell your story. So you got to respect the fact that a credit officer is looking at a piece of paper with the black and white ink on there, and they have to make the decision on the 3-4 lines and your payslip or financials. So your broker, who's hopefully representing you in that application, needs to position your story as best as possible, so that in fairness, the credit officer can go, okay, well, this makes sense. I understand, yes, they can't make particular principal repayments now, but in a year's time they are going to be doing it for A, B, or C reasons. So it goes to like a far broader position that you actually, or outlook that one has to have with regards to the story that you're actually putting in front of that credit officer.
And Charles, the same could be said for a real estate agent, because not every vendor takes the highest amount of money. Is if someone sells their story well to the real estate agent and they can transact quicker or do something different, then the better story could get the deal.
Yeah, it is that, and Dean's absolutely right. I mean, if I'm sitting there as in a credit department, I've got to know the story. I've really got to understand the story. And as black and white as many of the banks are being right now, there's still that little bit of relationship in there that can push it across the line. And so I think that when somebody wants to go for a loan, they've got to be incredibly prepared. Go to a broker, because a broker can help you get prepared. And that's the difference between going direct to a bank. I think that's an issue that a lot of people sometimes overlook.
Now, Dean, you brought an example with you that we'll pull up on the screen at the moment, and this is all about borrowing capacity, that one person's circumstances, you can get multiple different results from different banks.
Correct. Unfortunately, the market as a whole, it's all about the interest rates. Whether it's 3.65, 3.7, it's quite skewed towards what the actual interest rate is, where there's far more important pillars in our view in terms of what your mortgage broker should be presenting to you. And unfortunately, if you're walking directly into a bank, the bank can only sell you what they have. So if you look at an annual income of whatever their family income is, and in this case there's a married couple with 2 dependents, one of the key factors here is that in this particular case they're spending approximately $3,300 a month. This is one of the key items that have changed in the last year, where banks are actually now for the first time looking at clients' expenses. They're going through every single line item as to what they've actually spent. And so even if you actually do spend $3,300 a month, they actually may apply $4,000 or $4,500 to you. And for every $1,000 that you spend per month, it actually reduces your borrowing capacity by nearly $120,000 to $150,000. So it's quite significant.
And so we'll bring up on the next graphic that actually says the difference between the different banks, just coming up there now. And it's absolutely amazing. The difference is going from kind of in the 800s to well over $1 million.
Yeah, 100%. That's, or $200,000 difference. And that's because a certain bank may treat dividends differently. They may treat bonuses differently. So you go into an auction and you're wanting to spend $1 million, or you have $1 million that you think that you can afford in terms of repayments, but your particular bank will only lend you $850,000. Your mortgage broker will be able to actually say to you, well, let's go to lender B. They may be slightly more expensive, but they'll actually get you the funds that you need.
Now, Charles, a lot of people say when they're learning about properties, I'll never tell your agent about how much you can borrow. But this is probably a perfect example that if someone says, look, I'm only maxed out at $1 million, and the agent knows that the property you need another 50 to get in there, if he can link you up with the right broker, suddenly it's the difference between you can afford that property or you can't, and then you can.
It's not never tell them how much you can borrow, it's never tell them how much you're willing to pay. But
exactly.
A big difference between the two, or how much you can afford. Yes, you're right. Again, that comes back to having a relationship with the real estate agent too. We keep talking about the fact that if you've got that relationship with the real estate practitioner, a strong one, ongoing one, even after you've bought, you take your family, your friends, etc., to that particular person, the advice that you get, the flow of information you get, the changes in the market, any information that's going on, they're going to keep you updated. So yes, if you've got that relationship, an agent can help you do better, and their job is to get the best possible price for a seller. So the more that they can find out about you, the better they can do for the seller.
Now, Dean, whether we like it or not, at some point in time interest rates are going to rise. So how do you actually start preparing your clients for that fact?
We, at Mortgage Advice Bureau, we're using this hashtag at the moment called On Your Terms. And we never sort of, I don't quite understand why, at some point in time, interest rates are going to increase, whether it's a year, 2 years' time, 3 years' time. And so at the moment, if your interest rate's 4%, we try and push our clients to pay an extra $50, $100, $200 a month, because in 2 years' time, when rates increase by 0.5%, you're going to have to fork that back, into the bank's pocket. So our view is put that into your pocket, because the interest portion at the outset is the greatest. So if you can pay that extra $200-300 a month, it makes $10, $20, $50,000 difference to the life of the loan in terms of the total cost of interest.
So prepare in advance, always the way to go. Okay, Charles, let's have a look at the auction numbers and see what's happening around the country.
Yeah, in Sydney did better than Melbourne 2 weeks in a row. So I don't know what that tells you. But the clearance rate nationally were 57.9%, and this time last year they were 71.1%. So there's a big difference between the two. But Sydney did have that #1 rating behind Canberra. Canberra actually came in at 66.7, so it was the best performer of all. But there wasn't one single capital city that did better than this time last year. But Sydney came in at 59.1% and they had 717 auctions. And Melbourne came in at 58.6%. Now here's the interesting thing with Melbourne. It had 898 auctions, but this time last year it was over 1,200 auctions. So there's a massive difference between the two, and between the two cities and between the two markets between now and this time last year. Hard to tell.
Now, obviously mentioning Canberra, a lot of things have happened in the political scene, unless you've been asleep for the last week.
Well, yeah, if I'd have put my money down, I would have lost, for sure.
Are we going to see anything different in the clearance rates, or does it really not matter?
No, I don't think it matters at all. I think, quite honestly, the real estate market's it's getting belted, and it's getting belted in a way it probably should be, with the way in which the prices went crazy. And I think we need that adjustment. Otherwise, we're going to have a marketplace that could get to a point of a crash. So we're better off now having that adjustment over the next 12 months than having the market moving rapidly. There are a lot of agents moving out of the industry, Chris, right now, because it's very, very different for some, and there are a lot of agents making adjustments to their business right now.
And what about homes advertised for sale?
Yeah,
and will you see any difference on that as well?
I think we'll definitely see an increase in that. We've been seeing it progressively each week. It's only a small incremental increase of 0.89% over this time last week, but 8.18% is the amount of stock advertised for sale right now compared to this time last year. So that is a significant amount of property for sale. Still, you've got pockets where there are no listings, but that's very rare. In a lot of part of the country, there's plenty of stock around.
And then moving on to the rent price movement.
Yeah, they've been all right. The rent price, it hasn't really changed a lot. It's stabilised this week. The two performing capital cities that are doing the best are still Melbourne and Adelaide. I mean, Hobart's strong, but just in terms of incremental moves each week, Melbourne and Adelaide are doing the best. And still you have places like Darwin, I hate to do this comparison, but Darwin and Sydney that are doing the worst when it comes to rent. No, you could never have said that in the past, but these two capital cities, poles apart, that are now operating in a similar marketplace when it comes to rents.
And then finally the vacancy rates.
Yeah, they've been very, very steady. Melbourne climbed over into the 1% area a couple of weeks back. And it's come back again this week, 0.74% vacancy rate. It's an incredible vacancy rate when you look at the fact that Perth's 8.61, although Perth has been incredibly high for a while. I'm pleased to say that Perth's been in the 7s and 8s now for a couple of months, whereas it was over in the 10s and up to 11s. So that's a really good indication that market's improving. And if you look at Sydney, it came in at 2.04%. Last week it was 2.44%, so it's notched back a little. 3.79% is the average for those three capital cities.
Wonderful. Well, certainly some things changing there. And Dean, I guess another one of the changes when we're coming back to the mortgage side of things is there's so many banks now that want us to move to principal and interest versus interest only. If you want to stick on that interest only, is there anything you can do, or will you just be forced?
Again, it sort of goes back to the story that you have to tell. There needs to be a story. You can't. They don't want to hear that you're sticking on interest only because you can't afford that principal repayment. The bank is most concerned that you have the ability, or borrowers have the ability, to get them to repay their money, and they can get their money back. So if you are on interest only because you're putting that money into super or you're putting that money into your business, but you can demonstrate to the bank that you will have sufficient assets come the end of your term and you can pay that loan back, they won't have an issue with that, and your mortgage broker will be able to present it in that fashion. But as long as you're building that story around it, it still is okay.
And Charles, the good old days when you used to get a mortgage 30 or 40 years ago and you used to have an endowment policy or something like that, a savings plan to go and pay it, and literally they don't ask you till the day you pay back the mortgage, right?
Well, those were the days when you could borrow 120%, I think, Chris. But I think it's important to note that the banks are concerned about negative equity, which they've experienced in markets in Perth, and I think they should be concerned about it.
Sounds good. Thanks for joining us as always, Charles.
Thank you.
Now, we're going to take a short break, but we'll be back soon.
You're watching Sky News Real Estate. Smart investing.